Welcome to the Holistic Accountant Podcast. This is where we cut through conventional accounting and show you how a genuinely holistic approach drives better after-tax outcomes. It's not about ticking boxes or churning out tax returns. It's about strategic advice that builds lasting wealth. If you find this episode valuable, leave a rating and share it with someone who will benefit. Okay, today Mena and I would like to talk about Div 7A. And quite often we've done a few episodes on Div 7A, and normally we're very anti Div 7A. This, and I should clarify, Division 7A is really when you take money out of a company, so your trading company, without paying either a dividend or salary. So you've used the company's money, but it's still the company's money. And so in those situations, the law tells us that we need to arrange a Div 7A loan, which means that you need to borrow those monies off the company and pay interest. And the consequence of that is that the company will then pay tax on that interest revenue that you owe it. And at an interest rate of 8%, that can become quite expensive debt. And if not well thought out, it can become a compounding tax problem. And quite often we find Div 7A loans exist as a result of lack of forward planning. And so that's why we've typically, that's what we've typically said is that, try and avoid them wherever possible, really think about your long-term distribution strategy, and ultimately it should be to try and balance out taxation outcomes with still achieving your personal financial and lifestyle goals. But what we wanted to do today is sort of change tact a little bit and talk about when would we actually use a Div 7A. So what situations is it acceptable to use it?
So I'd like to make it clear that we'd still use Division 7A on occasion as long as the strategy is discussed. The problem is that what we find with some clients or clients that we've inherited is that there's a pattern around the fact that people are moving money without any sort of records, without any sort of understanding as why those monies are moving, and they're not actually compliant. They're not keeping up with the Division 7A repayments. They're not charging the right interest. There might not be the loan agreement in place for that Division 7A loan, but yet again, the loan agreement is probably the lesser of the issues. What's the issue is the undocumented drawings, the mixed accounts, and it's a year-end scramble to try to figure out what's actually happened. Now, what founders typically do is, my accountant will sort of figure it out at year-end, but it becomes a cascading problem. The problem is that when there's no strategy around those Division 7A loans, that they can accumulate year on year, and then we're sort of chasing our own tails to sort of try to find out what are we actually going to do with these Division 7A loans? Are we just going to keep paying 8% interest and just sort of hope that one day they'll go away? It sort of creates a sense of false comfort that the paperwork can really fix itself. We'll process a few journal entries and all of a sudden we're compliant with the Division 7A problem. What people don't understand is that it increases your retained earnings. It creates an asset protection risk in your business because all of a sudden you've got a whole bunch of retained earnings that could be subject to litigation. So it's really important to understand what underlying strategy are you going to put in place to actually deal with these Division 7A problems.
Okay, when it comes to Div 7A loans, there's really two options that we can consider. A standard 7-year loan agreement, which is an unsecured loan between the company and typically you, the shareholders or related parties or whatever it might be, or a 25-year loan. Now, the 25-year loan has to be secured, which we'll talk about in a second. But the answer to which loan term that you use really depends on how fast you want to, or you'd be forced to repay the loan. And I guess part of that depends on the quantum of the loan, the size of it, but also how much you want to spread the tax repayments over. So, if I'm going to have to repay, say, $700,000 over 7 years, it means I've got to declare an after-tax dividend of at least $100,000 more, probably to cover interest a year, which is going to give rise to a large, taxation outcome. That's going to crystallize maybe $150,000 of taxable income each year. That's going to be really costly. Whereas if I can repay that $700,000 and spread it over a 25-year period, well, then my repayments are going to be lower. And it's really just about balancing out the impact of the requirement to pay dividends, the possibility that, by reshuffling assets around in the future, that you might actually end up repaying that Div 7A loan. And so that can occur, in a situation where someone's retired and that entity isn't trading anymore, for instance, but also then balancing out the amount of interest that you're going to pay. And remember, whilst the interest is really a paper entry, the reality is that the company has to declare that interest as income. So there is a tax effect to that outcome. So the more interest you pay, even though you're only paying it to yourself, well, really the company which you own, you still need to understand that there's a tax implication. Having said that, you get a credit for the tax that you have to pay. And eventually, if you pay dividends out over a longer span of time, you might get a refund of that tax. Confused? It is confusing. There's a lot of different elements moving in different directions, and it's difficult. The challenge really is it's not just an entity specific decision, as in let's think about what's best for the shareholder or let's think about what's best for the company. It's a much wider decision than that because it also does sort of filter out into, okay, where do we hold, where is our wealth held? What is the longer term plan? When are we going to retire? What will our future taxation position be? Now, as I said, the 25-year loan has to be secured, and it's got to be secured on a commercial and made on a commercial basis, which means that you've got to have some property or, something of security that a commercial lender will take. And you've got to be able to point to, an example of that occurring. So the thing is, you need to make sure that you've got enough room in your loan to value ratio for that to work. So there's no point saying, well, I'm securing the loan, but it's 100% of the value of the asset. If you can't point to a commercial lender that's going to lend you 100%, and sometimes that can happen. I'm not saying it doesn't exist, but you've got to provide evidence that it's done on a commercial basis. And so we want to really think about, how does that suit you? Do you have an asset that has enough equity in it to secure a loan? And then you've got to set those arrangements up, as I said, on a commercial basis. So you've got to register a mortgage, which means you've got to go to a solicitor and they'll register a mortgage against the title. And how is that going to impact, in terms of your future as well, in terms of refinancing if you've already got debt against that security? So there's some practical elements here that need to be considered that reach beyond just taxation considerations.
So these lower repayments really help cash flow, and that's the idea here, but they're not always free. So it's really important to understand when we would actually use a 25-year secured loan, because small annual repayments might improve your short-term cash flow. But again, I'm going to come back to the strategy issue. It doesn't make the agreement or the terms around the Division 7A commercially better. So the real trade-off here is the repayment relief versus the actual cash committed over time. Now, sometimes we encourage clients to actually get the funds out of the company, not only for asset protection reasons, but for the fact that they can actually use those funds for investment. What you got to understand is the opportunity cost of that money. So if you're a business, for example, business owners in their 30s or 40s, and you've got a cascading Division 7A problem, and you're going to be looking at working in for the foreseeable future, and you're always going to be sort of in that top marginal rates, then we might want to get those funds out so that we can better use those funds, whether to be upgrade the family home or use it to purchase another investment property or invest in the markets. It's really important to understand what those funds inside your business is actually costing you by not getting them out. And then there's also the framework around establishing these loans. These loans aren't relatively cheap to set up in a sense, but they still cost you money in the sense that there's still legal work associated with registering a mortgage. There's got to be certain caveats in place, loan agreements, and then obviously there's the administration and ongoing compliance from your accountant. So it's really important to understand when these strategies are used and why you would use them. So for example, we've used them in the past where we've known a client might be heading towards retirement. So we've retained a lot of funds in the company and then put the loan on a 25-year arrangement to then basically drip feed out the dividends over the course of the retirement to benefit from the franking credit refunds. So again, really comes back to this strategy. The commercial question is simple. What is this strategy costing you in order to preserve the flexibility?
The other thing we need to think about is that we don't want to just react to symptoms, I should say. We want to fix the actual underlying problem. So a 25-year Div 7A loan agreement isn't just a magic bullet. We really need to understand, where the problems arise. So for example, if we've got a client that's pulling a lot of cash flow out of a trading entity, why is it occurring? Is it because they've got, poor leverage outside of the business and, because they're under leverage average, they're always sort of requiring that cash flow? Do they have, what are are they overspending relative to their earnings? Because that's entirely possible as well. But we really want to understand what the process is. That is, we want the 25-year loan agreement to be a strategic step rather than a reaction to a worsening underlying problem. The other thing to be mindful, as Mena spoke about at the beginning, is just to make sure everything is nice and clean. So the ledgers are clean, everything is reconciled. We've got, proper audit trails, end of year process is correct. Again, we want to make sure, remember, the onus is on you, the taxpayer, to prove that the treatment that you've used is correct. And so if we've got really messy records, that can be difficult because the ATO is just going to turn around and go, no, bad luck, it's non-complying, it's a deemed dividend, in that year you'll end up with potentially a huge tax liability. So we want to make sure that we don't fall foul of that our processes and our data and everything that we've done is correct and we've dotted the I's and crossed the T's.
Okay, so hopefully that gives you sort of a context around sort of common Division 7A problems and how we would sort of approach a 25-year loan and when we would use it. But I think the key here is to really understand or what you want to obtain from those funds from your business and how you're really going to account for it. So get in touch with your holistic accountant to understand or model the cash flow first, document what those loans actually would look like and how you're going to use those funds before you enter into that sort of Division 7A agreement. So we'll leave it there. Until next week, bye for now.